Imagine that it is October of 1930. You are a grain farmer in rural Nebraska. You have worked the same land for 30 years. You have watched seasons come and go. You have seen good years, bad years, droughts, storms, high prices, low prices, and every kind of uncertainty that a farmer can live through. Last month, after selling your harvest, you deposited $4,200 into the First National Bank in your small town. That money is not speculation. It is not gambling money. It is not money you put into some risky stock because you wanted to get rich quickly. It is the product of a year of work. It is the seed money for next spring. It is the food money for winter. It is the money that separates your family from hardship. Then, on a Tuesday morning, you drive into town to withdraw $80 for supplies. When you arrive, there is a line outside the bank. At first, you think it is just a delay. Then you hear the voices. People are murmuring. Some are angry. Some are frightened. The doors are locked. There is a handwritten sign taped to the glass, closed until further notice. You push closer. You knock on the door. A clerk inside sees you, then looks away. He does not open the door. He does not explain. He does not make eye contact. He simply walks away. Your money is still inside that building. You can see the vault from the window. You can see the place where you believed your savings were being kept, but you will never touch that money again. Not $1. The bank has failed. Your deposit is gone. There is no insurance. There is no appeal. There is no customer service department that can fix it. There is no emergency line. There is no politician coming to save you before winter. Within roughly 2 years, thousands of American banks will close their doors in the same way. A huge amount of the money Americans believed they owned will simply vanish. Not because they lost it in the stock market, not because they were reckless, not because they speculated, they deposited it, they trusted the system, and the system erased it. That history matters now because the basic structure that made that kind of loss possible was never fully eliminated. It was covered over. It was renamed, it was insured in part, it was regulated in part, it was made to feel safer. But the deepest architecture remained. When you deposit money in a bank, you are not putting your money in a vault with your name on it. You are lending your money to a private institution. You become a creditor of that institution. The bank becomes your counterparty. And if the counterparty fails, the order in which claims are paid matters more than what you feel you own. That is the first principle people need to understand. There is a difference between access and ownership. Most people confuse the two because the system works smoothly most of the time. You swipe a card and the payment goes through. You open an app and the balance appears. You transfer money and the number moves. That repeated experience creates the feeling of ownership. But in law and in structure, a bank deposit is a claim. The bank owes you money. The cash itself is no longer sitting there as your specific cash. It is part of the bank's balance sheet. It can be lent. It can be invested. It can be tied up in assets that cannot be liquidated quickly without losses. In normal times, that distinction does not matter much. In a crisis, it is the only thing that matters. That is why I want to walk through the system slowly and carefully, not to create fear. Fear is usually a poor basis for good decisions. I want to show you the machine, because when you understand the machine, you stop thinking in slogans and start thinking in probabilities, trade-offs, and consequences. Most people believe money in the bank is simply safe. They believe the building is solid, the vault is thick, the teller is calm, the website works, the government insures deposits. The Great Depression happened almost a century ago, and surely the system learned its lesson. Some of that belief is based on real improvements, but some of it is based on messaging. The banking system depends on confidence, so the language around banking is designed to create confidence. The word deposit sounds like storage. The word account sounds like possession. The word balance feels like something that exists exactly as shown. But the balance is a liability of the bank. The bank owes you. That is different from saying the bank is holding your exact money for you. When you give a bank cash and it credits your account, the bank receives an asset and issues a liability. The asset belongs to the bank. The liability belongs to you. You are now waiting to be paid back on demand. This works because most people do not demand their money at the same time. That is the hidden assumption behind the entire system. In quiet conditions, deposits come in, withdrawals go out, and the bank keeps enough liquidity to handle the normal flow. It lends a portion of deposits to borrowers. It buys securities. It earns income on those assets. It pays depositors less than it earns. That spread is part of how banking works. But banking is built on a maturity mismatch. The deposit can be demanded immediately. The loan may not be repaid for years. The bond may not mature for years. The mortgage may not return principal for decades. So the bank funds long-term assets with short-term liabilities that can be profitable. It can also be fragile. In 1929 and the years that followed, that fragility became visible. The stock market crash became the symbol of the Great Depression. But the banking collapse was the mechanism that did much of the damage. People often remember Black Tuesday, the headlines, the panic, the fall in the Dow, but the devastation that reached ordinary families, ordinary businesses, and ordinary towns came when the banking system broke. At the time, the United States had thousands of commercial banks. Many were small, many were local. Many were tied directly to the fortunes of the communities they served, and they operated under fractional reserve banking. Fractional reserve banking is simple to describe, but easy to misunderstand. If you deposit $1,000, the bank does not keep the full $1,000 in a vault waiting for you. It keeps a fraction and lends or invests the rest. The borrower receives that money and may deposit it into another bank. That bank keeps a fraction and lends the rest again. Through this process, a single original deposit can support a much larger amount of credit in the system. In good times, that helps an economy grow. It finances homes, farms, factories, inventories, and payrolls. Credit expands, business activity expands, people feel wealthier because claims on money increase faster than base money itself. But every credit expansion has a condition attached to it. It requires confidence. Confidence is the load-bearing wall. When depositors trust that they can get their money, they usually do not all ask for it at once. Because they do not all ask for it at once, the bank can meet withdrawals. Because the bank can meet withdrawals, confidence is reinforced. That is the virtuous cycle. But the same mechanism can reverse. When depositors fear that they may not get their money, they hurry to withdraw. Because many hurry to withdraw, the bank cannot meet all claims. Because the bank cannot meet all claims, the fear becomes justified. That is the vicious cycle. A bank run is not only a panic, it is a mathematical event. It reveals that the system has more immediate claims than immediate cash. In December of 1930, the Bank of the United States failed. Despite the name, it was not a government bank. It was a private institution. It had hundreds of thousands of depositors. When it collapsed, confidence broke in places far beyond that one bank. Rumors spread. People in small towns began asking a simple question. If that bank can fail, why not mine? Then they went to the bank to withdraw just in case. But in banking, just in case can become the cause. Between 1930 and 1933, more than 9,000 banks failed. Depositors were wiped out, businesses lost payroll accounts, farmers lost seasonal cash, families lost savings they had built over years. They had not taken a market risk in the way we normally define risk. They had taken counterparty risk without realizing it. This is one of the most important lessons in all of finance. The risk you do not understand is often the risk that gets you. People understood the risk of stocks because prices moved every day. They did not understand the risk of deposits because deposits looked stable every day. But stability can be an illusion when it is maintained by confidence. After the banking crisis, the United States created the FDIC. The purpose was to restore trust. If a bank failed, depositors would be reimbursed up to a certain limit. The original limit was small. Today, the commonly understood limit is $250,000 per depositor, per insured bank, per ownership category. For most people, that sounds like the problem has been solved. But a principle-based thinker should always ask, solved under what conditions? Deposit insurance works well for isolated failures. One bank fails here, another bank fails there. Regulators step in. The insurance fund covers insured deposits. Another bank may acquire the failed bank, customers regain access. That is the design scenario. The more difficult scenario is systemic failure, many institutions under pressure at the same time. An insurance fund is not a magic pile of unlimited money. It has resources, it has access to additional support. But if the system-wide claims are large enough, the fund must rely on government borrowing, Treasury support, or money creation by the central bank. At that point, the problem has not disappeared, it has changed form. The loss is no longer only a depositor loss. It becomes a taxpayer loss, an inflation risk, a currency risk, or a political decision. This is why I do not like simple answers. People say, my deposits are insured. That may be true within the limits and the rules. But if you are over the limit, the question changes. If the failure is large enough, the question changes. If access is delayed, the question changes. If the government chooses a discretionary rescue, the question changes. The example of Silicon Valley Bank in 2023 shows how this works in modern form. A very large portion of its deposits exceeded the insured limit when the bank failed. The government chose to make all depositors whole. That decision may have prevented contagion. It may have been the right decision under the circumstances. But the key point is that it was a choice. It was not an automatic promise embedded in every bank account. The government used emergency tools and a systemic risk exception. That tells you something important. In a crisis, the official rules and the practical outcome can diverge based on the size of the problem, the political context, and the perceived risk to the broader system. That is not certainty, that is a policy response. If your bank fails and your deposits are above the insurance limits, you are exposed to a set of decisions made by regulators, politicians, and market conditions. Maybe you are made whole, maybe you are not, maybe you wait, maybe access is restored quickly, maybe the money is available but delayed when you need it most. Liquidity matters because bills do not wait for regulators. That is why the question is not just, will I eventually get reimbursed? The question is, can I access what I need when I need it? In a crisis, timing is part of safety. Now consider the bail-in mechanism. Most people understand bailouts. In a bailout, the government injects money into a failing institution. The cost is pushed onto taxpayers or into public debt and currency creation. After 2008, bailouts became politically toxic because ordinary people watched institutions being rescued while households suffered. So regulators built another mechanism. Instead of a bailout, the system can use a bail. In a bail, certain creditors of the bank absorb losses. Their claims can be written down, converted into equity, or otherwise used to recapitalize the institution. Shareholders are hit first, then certain debt holders then, depending on the jurisdiction and the structure. Uninsured depositors can become part of the loss-absorbing stack. This is not a conspiracy theory. It is how modern resolution frameworks are designed. Cyprus in 2013 showed the world what this looks like. During the banking crisis there, deposits over the insured threshold were hit directly. A portion of uninsured balances was effectively converted into bank equity. Some depositors lost a large percentage of their uninsured money almost overnight. That was not the same as inflation slowly reducing purchasing power. That was a direct hit to deposits after Cyprus bail. Rules became part of formal banking resolution frameworks in various developed jurisdictions. The idea is that creditors, not taxpayers, should bear losses when a bank fails. There is logic to that. But if you are the creditor, the logic becomes personal. And remember the earlier principle, a depositor is a creditor. That is why it is so important to understand what you actually own and what you merely have a claim on. Now the practical question becomes, if banks are counterparties and counterparty risk exists, where should cash be stored? There is no perfect answer. Anyone who tells you there is a perfect answer is usually selling certainty where none exists. Every form of safety has a weakness. Every haven has a condition under which it fails. The goal is not to find a zero-risk asset. The goal is to understand different risks and not concentrate all of your vulnerability in one place. Let us start with physical cash. Cash held outside the banking system has one obvious strength. It cannot be frozen by a bank failure. It cannot be bailed in. It does not depend on a banking app working, a wire being processed, or a regulator reopening a failed institution. In a deflationary banking collapse, physical cash can become extremely valuable because prices fall and liquidity is scarce. In the Great Depression, those who had cash outside failed banks had options. They could buy necessities, they could survive delays, they could act while others were locked out. But physical cash has serious weaknesses. It can be stolen, it can burn, it can be lost, it earns no interest, and if the crisis is inflationary rather than deflationary, cash loses purchasing power every day. In Weimar Germany and Zimbabwe, physical currency did not protect wealth. It was the thing being destroyed. So the correct question is not, is cash safe? The correct question is, safe from what? Safe from a banking freeze, perhaps safe from inflation? No. Safe from theft? No. Safe from currency debasement over long periods? No. That is how serious investors think. They do not label an asset safe or unsafe in isolation. They match assets to scenarios. Then there are Treasury securities. When you buy a Treasury bill, note, or bond directly from the United States government, you are lending to the federal government rather than to a private bank. Treasuries are considered the core dollar asset in the global financial system. They are the collateral backbone of markets. In a banking crisis, many investors move toward Treasuries because they are claims on the sovereign, not on a single bank. But even here, there are layers. If you hold Treasuries through a brokerage, you have brokerage infrastructure risk. Your securities should be segregated and protected under relevant rules. But if the broker fails, access can still become slow and complicated while the situation is resolved. If you hold Treasuries directly through Treasury Direct, you reduce intermediary risk, but you may reduce ease of use. Selling quickly can be more cumbersome. The platform may not be as convenient as a brokerage account in a fast-moving personal liquidity need. Convenience can matter. Again, no perfect answer. Only trade-offs. Money market funds are another tool people often treat as cash, but they are not bank deposits, they are securities. They typically invest in short-term, high-quality instruments. In normal conditions, they can be useful cash-like vehicles. But history shows they can come under stress. In 2008, a major money market fund broke the buck after exposure to Lehman-related assets. Investors panicked. Redemption pressure rose. The government intervened to stabilize the market. That intervention mattered, but it was not the same thing as saying every money market fund is cash, always available under all conditions. If you use a money market fund, you should understand what it owns, who manages it, whether it is government only or prime, what liquidity features it has, and what could happen in a stress event. The same principle keeps repeating. Know the structure before the structure is tested. Gold and precious metals are different. Physical gold exists outside the banking system. It has no counterparty if you own it directly and store it securely. It cannot be printed. It does not default. It has carried value across civilizations, currencies, and political systems. That is why people reach for it when they do not trust financial promises. But gold has its own risks. It produces no income. Its price can be volatile. It must be stored. If you store it in a bank-safe deposit box, it may be inaccessible during a bank holiday or banking disruption. If you store it yourself, you create security and loss risks. There is also the historical fact that in 1933, the United States government restricted private ownership of gold bullion through Executive Order 6102. That happened. It is not speculation. It reminds us that even assets outside the banking system can become subject to government policy in extreme conditions. Silver and other metals have similar but different trade-offs. Silver may be more volatile. Platinum and palladium are more specialized. The point is not that one metal solves every problem. The point is that metals are a different type of risk from bank deposits. Different risks diversify each other. Foreign currencies and foreign accounts can add another layer of diversification. Holding Swiss francs, Singapore dollars, or accounts in jurisdictions with strong property rights may reduce dependence on one banking system and one currency. For people with the resources and the need, that can create optionality, but it also creates complexity. There are reporting requirements, there are tax obligations, there is currency risk, there are foreign legal systems you may not understand. For Americans, foreign accounts above certain thresholds must be reported, and failing to comply can create severe penalties. So foreign diversification is not a casual move. It requires knowledge, compliance, and professional guidance. Real assets are another category: land, property, productive assets, commodities. Things that exist in the physical world. They cannot be bailed in by a bank in the same way a deposit can. They cannot be erased by a failed banking ledger. They may have used beyond financial price. A farm can produce food. A building can provide shelter or rent. Certain commodities can have practical demand, but they are not liquid. You cannot walk into a grocery store and spend a farm. You cannot quickly sell a building at a fair price in a crisis if buyers have no credit. In deflationary environments, real asset prices can fall sharply because cash becomes scarce. In inflationary environments, real assets often preserve value better than cash claims. Again, safe from what? That is the discipline. The mistake most people make is searching for one place to put everything. That is not how resilience works. Resilience comes from not needing any single system to work perfectly. If all of your money is in one bank, you have bank-specific risk. If all of your money is in one currency, you have currency risk. If all of your liquidity is in physical cash, you have theft and inflation risk. If all of your safety is in treasuries, you have sovereign and access risk. If all of your wealth is in real estate, you have liquidity risk. The intelligent approach is to map the risks, then decide which risks you can tolerate, which risks you must reduce, and which risks you are being paid to take. The people who survived banking crises better were not always the people who predicted the crisis. Prediction is hard. It is often impossible. They were often the people who built optionality before they needed it. They had more than one path. They had more than one institution. They had some liquidity. They understood that convenience and safety are not the same thing. This is why history is so useful. In 1929 through 1933, the greatest pain fell on people who had no options. Small depositors in small towns trusted a single local bank when the doors closed. They had no alternative access, no political leverage, no legal team, and no time. In Cyprus, uninsured depositors discovered that bank balances above the protected amount could be part of a resolution plan. Ordinary people also experienced capital controls, withdrawal limits, and restricted access. In Argentina in 2001, accounts were frozen during the Corralito. Savings were trapped. Deposits were converted. The middle class learned that the rules can change when the system is under pressure. These are different countries, different times, and different details. But the pattern is the same. When the system is stressed, the costs are distributed. They are not distributed equally. Those with optionality, mobility, information, and diversified claims usually do better than those who assume everything will work as advertised. This is not a moral statement. It is a structural one. The system does not protect the uninformed simply because they are innocent. It rewards those who understand its mechanics before the mechanics matter. Now bring the lesson forward to the modern banking system. Today's system is larger, faster, more regulated, more technologically advanced, and more interconnected than the system of 1930. That creates strengths. It also creates new kinds of fragility. Banks hold securities, they hold loans, they are exposed to interest rates. They are connected through payment systems, derivatives, funding markets, and confidence channels that move at digital speed. A rumor that once spread through a town square now spreads through phones in minutes. A bank run that once required people to stand in line can now happen through an app. Silicon Valley Bank did not take years to collapse. The decisive phase happened extremely fast. A balance sheet problem became a confidence problem. A confidence problem became a liquidity problem. A liquidity problem became a bank failure. One of the key mechanisms was interest rate risk. When interest rates rise rapidly, the value of existing long-duration bonds falls. A bank may hold those bonds and classify some losses as unrealized. As long as depositors do not demand large withdrawals, the bank may not have to sell. The loss can remain hidden on paper. But if depositors want their money and the bank must sell those securities at a loss, the hidden loss becomes real. Then people see the loss, then confidence falls. Then more withdrawals come. Then the liquidity problem accelerates. That is the same old pattern in modern clothing: short-term claims, long-term assets, confidence as the load bearing wall. Central banks can respond, regulators can create emergency facilities, governments can guarantee. These tools matter. They can stop contagion, they can reduce panic, they can buy time, but they do not eliminate the underlying trade-off. If inflation is high, cutting rates to save banks can weaken the currency and reignite inflation. If rates remain high to fight inflation, pressure remains on bank balance sheets and borrowers. If the government guarantees everything, public liabilities expand. If depositors take losses, confidence can break. There is no painless path. That is why I look at these things as systems. A banking crisis is not a single event. It is the interaction of balance sheets, confidence, liquidity, law, politics, and human behavior. Human beings tend to do the same things repeatedly. When things are calm, they reach for yield and convenience. When things become uncertain, they reach for liquidity. When everyone reaches for liquidity at once, institutions built on illiquid assets can fail. That is the cycle. It happened in different forms in 1929, in 2008, in 2023. And in other countries at other times, the reasons change, the names change, the instruments change, the pattern remains recognizable. So what should a thoughtful person do with this knowledge? Not panic. Panic is just another form of bad decision-making. The goal is to understand what kind of claims you own, who the counterparty is, what the legal priority is, what the access conditions are, and what happens under stress. Ask simple questions. If this bank closed for several days, what would I do? If deposits above the insured limit were delayed or impaired, what would I do if my brokerage account were temporarily inaccessible? What would I do if inflation were the main problem rather than deflation? What would I do if the dollar weakened? What would I do if cash became hard to access? What would I do? These are not predictions. They are stress tests. Good investing and good risk management are not about knowing the future. They are about surviving a range of futures. Most people do not study failure until they are inside it. That is too late. The time to understand bank mechanics is before the doors close, before the app freezes, before regulators issue a statement, before everyone else realizes that the thing they thought was money was actually a claim on money. A bank is not a vault. A bank is a counterparty. That sentence changes how you see the world. It does not mean banks are bad. Banks are essential to the modern economy. They create credit, they finance productive activity, they enable payments, commerce, and growth. The system is useful, but useful systems can still be fragile. A bridge is useful, you still want to know its load limit. A machine is useful, you still want to know what happens when a part fails. Banking is a machine. It does what it is designed to do. It transforms short-term deposits into longer-term assets. It creates credit. It uses confidence as a stabilizer. It relies on liquidity not being demanded by everyone at once. The machine is powerful. The machine is also vulnerable. Those who understand that do not have to live in fear. They can live with preparation. In 1930, the farmer at the locked bank door did not lose money because he was foolish. He lost money because he trusted a structure he did not understand. In a time when the safety net did not exist, today safety nets exist. But they have limits, they have rules, they have political dependencies, they have timing issues, they work better in isolated failures than in systemic stress. That is the honest picture. Deposit insurance is real, but not infinite. Regulation is real, but not perfect. Central bank support is real, but not costless bail. Inauthority is real, but not usually understood. Emergency lending can stabilize a system, but it can also hide losses. The modern language is reassuring. The old structure remains underneath it: confidence management, loss distribution, system stabilization, resolution authority, liquidity facility. These are modern names for ancient problems: who gets paid, who waits, who takes the loss, who controls the timing. When too many people want out at the same time, not everyone can get out at once. That is the constraint. Once you see it, you cannot unsee it. And that is why the question is not simply where is the best place to store cash. The real question is, what mix of places gives you the best chance of maintaining access, purchasing power, and flexibility across different kinds of stress? For short-term disruption, some physical cash may solve a problem that a frozen account cannot. For bank counterparty risk, direct government obligations may solve a problem that deposits cannot. For currency debasement, some hard assets may solve a problem that cash cannot. For inflation, productive assets may solve a problem that idle money cannot. For jurisdiction risk, geographic diversification may solve a problem that domestic concentration cannot. But every one of those choices brings its own risk, complexity, and responsibility. That is why there is no substitute for thinking. The world rewards people who understand second-order consequences. A first-order thinker says, my bank is safe. A second-order thinker says, under what conditions, up to what limit, with what access delay, and with what legal priority. A first-order thinker says, cash is safe. A second-order thinker says, from bank failure, maybe, but not from inflation, theft, or long-term debasement. A first-order thinker says, gold is safe. A second-order thinker says, From default, yes. But not from storage risk, volatility, or potential regulation. A first-order thinker says, Treasuries are safe. A second-order thinker says, from private bank failure, yes, but not from interest rate risk, inflation risk, or access friction depending on how they are held. This is the kind of thinking that protects you, not certainty, clarity. When I study history, I do not study it to say the same crisis will repeat in the same way. It never does. I study it to see the mechanics that keep repeating because human nature and financial incentives keep repeating. People take confidence for granted until confidence disappears. People assume liquidity until liquidity is scarce. People believe rules are fixed until pressure causes rules to change. People believe access equals ownership until access is denied. The next crisis will have a different trigger. It may be rates, it may be inflation, it may be commercial real estate, it may be a large bank, it may be a cyber event, it may be something none of us can identify in advance. The trigger matters less than the structure. If the structure is fragile, a trigger will eventually test it. That does not mean you run from the system, it means you understand your exposure to it. The people who do best over long periods are not the people who are always optimistic or always pessimistic. They are the people who are realistic. They know that good times create leverage. Leverage creates fragility. Fragility meets a trigger, and the system then must distribute losses. That sequence has played out many times. It will play out again. The only unknowns are when, where, and through which mechanism. So the practical principle is simple. Do not let one institution, one currency, one legal framework, one asset type, or one assumption become the single point of failure for your life. That is not paranoia. That is system design. A strong system has redundancy. A weak system has one perfect path that must not break. Most people build their financial lives around one perfect path, one bank, one currency, one country, one app, one assumption that access will always be there. History says that is not enough. The farmer in Nebraska did not need a prediction. He needed redundancy before he needed it. The depositors in Cyprus did not need perfect foresight. They needed to know that uninsured deposits are creditors. Claims the savers in Argentina did not need to know the exact date of the freeze. They needed to understand that governments under stress can change the rules. The depositors in modern bank failures did not need to predict the bank run. They needed to understand the difference between insured and uninsured balances, between access and ownership, between liquidity and accounting value. That is the lesson. And it is a lesson worth learning before it becomes personal. This is educational analysis, not financial advice. You should speak with qualified professionals before making decisions about your assets, your taxes, your legal obligations, or your banking arrangements. But do not outsource understanding. Professionals can help you implement. They cannot care about your resilience more than you do. The banking system is not a conspiracy. It is not a villain. It is not evil. It is a machine built on claims, confidence, and maturity transformation. Machines are not moral. They operate according to design. If you understand the design, you can use the machine without being surprised by it. If you do not understand the design, you may mistake a claim for ownership, a balance for cash, insurance for infinity, and confidence for safety. That is the dangerous mistake. Because when a banking system fails, it does not fail politely. It fails by restricting access. It fails by delaying payments. It fails by freezing accounts. It fails by converting claims. It fails by changing rules after people have already made decisions based on the old ones. And by the time everyone understands what happened, the exits are crowded. You do not prepare because you know the next crisis is tomorrow. You prepare because you do not know when it is. That is the difference between fear and prudence. Fear says everything will collapse. Prudence says systems have weaknesses. And I should not make my family dependent on all of those weaknesses never appearing at the same time. Fear acts impulsively. Prudence builds optionality. Fear goes all in on one answer. Prudence creates several ways to survive being wrong. That is the framework I would use. Study the structure, map the risks, respect liquidity, understand legal ownership, stay within the rules, keep records. Avoid concentration, build optionality. Do not assume that because something has worked for years, it must work under stress. That is the lesson of 1929. That is the lesson of Cyprus. That is the lesson of Argentina. That is the lesson of Silicon Valley Bank. The details are different. The pattern is not. The pattern is that people trust the system most right before they discover what the system actually is. And what it is at its core is a chain of promises. Some promises are strong, some are insured, some are backed by governments, some are backed by assets, some are backed mostly by confidence, some are senior, some are junior, some are only liquid when everyone does not ask at once. Your job is to know the difference because when the next crisis comes, the question will not be whether you believed your money was safe. The question will be where your money actually was, who owed it to you, what rules governed that claim, and whether you had another path when that path stopped working. Most people never ask those questions. They see a balance and assume the story is finished. But the balance is not the story. The structure behind the balance is the story. And if you understand that structure now, before the next failure, you have something more valuable than panic. You have perspective. Perspective lets you act calmly while others react emotionally. Perspective lets you prepare without predicting. Perspective lets you use banks while not worshiping them, use insurance while not misunderstanding it, hold cash while not idolizing it, own assets while understanding their weaknesses, and build a financial life that does not depend on one fragile assumption. That is what the history of banking failures teaches. Not that you should distrust everything, that you should understand everything you depend on. The next crisis will not arrive with a polite warning. It will arrive through a locked door, a frozen app, a delayed wire, a policy announcement, a new facility, a new acronym, or a sentence from a regulator telling you the system is sound. Maybe it will be sound. Maybe it will be sound enough. But sound enough is not the same as risk-free, and if your life savings are involved, that distinction matters. So do not wait until you are standing in the line outside the bank. Do not wait until the clerk refuses to meet your eyes. Do not wait until the rules change. Learn the mechanics while there is still time to think clearly, because the deepest lesson from 1929 is not that banks can fail. The deepest lesson is that people can believe they own something right up until the moment they learn they only had a claim. And in a crisis, the quality of the claim determines the quality of your safety.